Right here now at Saba Capital Management's office in Midtown Manhattan, and joining me in a rare and exclusive interview is Boaz Weinstein. He's the founder and CIO of Saba Capital Management, made famous perhaps for the London Whale, but now bringing a new activist campaign to BlackRock, which is a fascinating new development in terms of going after their closed-end funds. You've made a strategy of going after closed-end funds now for several years. A lot of folks may not understand what a closed-end fund is. So before we even maybe get into the conversation about what is it that you're trying to do and going after the governance of BlackRock, a firm that's made its name in large part on the back of governance and governance issues, what are you trying to do with BlackRock?
Right. So closed-end funds they've been around for more than a century. A lot of the viewers will recognize the Grayscale Bitcoin Trust as a very famous closed-end fund. It was at a discount for years, a very deep discount. And when it converted into an ETF, the discount disappeared. Investors made something like 80 or 90% from that discount going away. On the New York and London stock exchanges, there are over 700 of these closed-end funds. They're portfolios of assets managed by venerable managers like BlackRock. And sometimes, unlike ETFs, unlike mutual funds, they trade at deep discounts to their objective value. And that discount can be corrected with the press of a button, and that's what we're here to do.
So just let's go into why do closed-end funds, as a matter of practice, seem to run at a discount? They trade at a discount almost across the board.
Right. So there are periods when they're at discounts, and in fact, there are many today that are at premium. But why do the BlackRock ones trade at discounts, and why in general do they? It's because there isn't really a sophisticated investor base who wants to own these products. They have high fees. And so at fair value, you could say, I'd rather be in an ETF that does the exact same thing. So I'm not going to buy it unless it's at a discount. And until it gets to double-digit discounts, there aren't really investors like myself that will take up the effort of buying them.
Okay, but what is it exactly that's your problem with BlackRock specifically? And you have been at war, dare I say, with BlackRock now for several years. And you've gone to court with them, too.
Successfully, yes. We won in federal court in December. One of the things we were at war with was that they were violating the Investment Company Act, the sacred 1940 Act, that they prevented us from voting all of our shares, even though the Company Act says every share gets to vote. And in federal court, on summary judgment, the judge said, Saba wins, BlackRock cannot do that anymore. So that was one thing. Our issue is not really about performance, though some of these funds have performed terribly, to use a technical word. In the last 3 years, 9 of the 10 funds that we're even talking about have lost money for investors, negative total return, 9 of these funds. Performance is one thing, but the performance is exacerbated by this discount because a dollar of stuff, whether it's IBM or Bitcoin or municipal bonds that BlackRock manages, despite their $10 trillion in their brand, a dollar of stuff is trading freely for 85 cents, 83 cents, 86 cents on the dollar. And our problem is that having become the largest shareholder in many of these funds, they're actually blocking us from speaking to shareholders. And ISS last year called them out and withheld on their nominees for what ISS termed abusive corporate governance practice.
Let me ask you this, though. Some critics would say, look, the closed-end fund is sold as a closed-end fund, meaning they raise money in the beginning, and the plan is for you to hold it for 12 years, and at the end of the 12 years, you get your money back and hopefully more than that. And yes, it may trade at a discount in between, but that's what it is. And that you, dear sir, are hijacking the process by saying, actually, no, the product shouldn't be this, it should be something else.
Right. So first, most of the funds that they have over 70, are forever funds. They're not 12-year funds. It's only recently that they've kind of tried to split the difference and make it have a term to it. So this idea that a fund that started as one thing needs to be that thing 9 years later, first of all, we don't have a plan to convert it from a closed-end fund into an open-ended fund necessarily. In the last decade, we've done this about 60 times, most of the time to get rid of this overhang of too many people wanting to sell it at a discount. The manager goes and buys back those shares. They tender for shares at net asset value. And investors who want to come out. The ones who want to stay can stay in their closed-end fund for 100 years if they want. And often that does get rid of the discount. There was a Neuberger Berman fund that did that, and they are trading today, NHS, at a premium after doing a tender.
How much money do you think is on the table here if you're successful for shareholders?
That's what's wild about this, because traditionally these were small funds, but BlackRock does everything in supersize. These 10 funds that we've nominated people to the board of, if BlackRock pressed a button, like we've done before 6 dozen times, and allowed investors to get out just at fair value. They don't have to be right about where AMC is going to trade tomorrow. They don't have to be right about the Fed. If it just traded at net asset value, the number is staggering, Andrew. It's $1.4 billion.